This is a video demonstration on corporate stock. In this video, I'm going to work the solution to example number 2. This example involves the Adams Company, and they have reported the following components of stockholders' equity. First of all, they have common stock. Their common stock has a $5 par. There are 100,000 shares authorized, but actually only 50,000 shares have been issued. They currently have paid-in capital in excess of par on the common stock of 64,000, and they have 110,000 in retained earnings from prior periods. Now, in the year of 2012, the following transactions occurred, and we have a whole series of different transactions here that took place throughout the year. And under the requirements on number 1, we just simply have to prepare the necessary journal entries for each of these transactions. So to do this, I'm going to utilize a journal entry page that I have set up in advance in Excel, and I just simply have a column for the date. I'm going to have my account titles and, of course, my debits and credits. Now, the very first transaction, this occurs on January 1st. They're going to issue 2,000 shares of common stock for $12,000 cash. So this will be on January the 1st. Now, if they're going to issue this stock and sell it for cash, then we need to debit cash because that's an asset that needs to be increased. And at the same time, we're issuing common stock. Now, that's going to be a credit because remember, on our capital components, they are credit positive. Now, on the cash, I'm selling this stock for $12,000. So I will debit cash for $12,000. But when I credit common stock, remember, I'm only allowed to put the par value on common stock. Always remember that. So in this case, if I go back and look at the par value of the stock is $5. So if they issued 2,000 shares, 2,000 times 5, that's $10,000. So essentially we sold $10,000 worth of stock for $12,000. We sold it a little bit above par. So to make this journal entry balance, I need another $2,000 on the credit side. And what's that going to go to? That's going to go to my paid-in capital, and this is on the common stock. So on paid-in capital on my common stock, an extra $2,000 that I made on that particular sale of stock. So that completes the transaction on the 1st. Now, January 31st, we decided to purchase 2,000 shares of our own stock for $22,000. So this is on the 31st. Now, whenever we purchase our own stock, that is called treasury stock. I want to debit treasury stock, and I want to credit cash because I spent the money, so the cash needs to be reduced. The money that I spent is $22,000. Now, in an example like that, or in a transaction like that, when I bought the 2,000 shares and paid $22,000, that insinuates that what I really paid is $11 a share. 22,000 divided by 2,000 is 11. And I'm just going to make a little note of that over here to the side. That's going to help me out later on. So this little note of this $11, that's not going to be part of the journal entry. But I'm just going to make a note of that because I'm going to need to know that later on when I start selling this treasury stock back. Now, the next transaction is on February 1st. Declared a 50-cent per share dividend. It will be payable on February 28th to the February 14th stockholders of record. So this is on February the 1st. Now, anytime we declare a dividend, it's a pretty standard journal entry in terms of the journal entry titles. The money for dividends comes from my retained earnings. And because I'm simply declaring this and not actually paying for it, that means I'm obligated to pay this. And that obligation is a liability called dividends payable. So that's a pretty standard set of titles on this type of journal entry. The challenge really is figuring out the amount. Now in this case it is a 50-cent per share dividend, but the questionable thing is at this point, how many actual shares do I have out there? Because remember, I don't want to pay a dividend on any shares that are in the treasury. I don't want to pay the dividend to myself. So go back and look at this. They started out with 50,000 shares issued. Then we issued an additional 2,000. That takes it up to 52. But then we bought back 2,000. So as of right now, as far as shares that are actually owned by shareholders, there are only 50,000. So that's going to be 50 cents per share for 50,000 shares. So that's going to be $25,000. So you always want to go back and double check that, because you never really know unless you go back and look at it how many shares are actually out there. I don't want to pay the dividend to myself. The next transaction is on the 28th, and on this date we are simply going to pay the dividend that we had declared on the 1st of February. So on this date we actually pay for this, which means we can remove the liability. Dividends payable will be removed. We will pay for it with cash, and we already know that it's going to cost us $25,000. The next transaction, March the 1st. Now we're going to sell back 1,000 of those treasury shares, and we're going to sell it for $12,000. So this is on March the 1st. If I'm selling back some of this treasury stock, I'm going to receive cash, so cash needs to be debited. I'm going to credit treasury stock because I'm selling it back. Now in this case, they said that I sold it for $12,000. But I don't want to credit treasury stock for $12,000. I'm going to credit treasury stock for only $11,000. Now why is that? Well, remember my little note that I put up here on my treasury stock. When I bought that treasury stock, I paid $11 a share. So when I take it out, put it back out there, I want to be consistent and use the same price. So even though I sold 1,000 shares for $12,000, really I had paid $11,000 for that. So what that means is I've got an extra $1,000 here on the credit side. And what that is paid in capital, and this is on the treasury. So that's an extra $1,000 that I made on my treasury stock. The next transaction is on March the 30th. Now I'm going to sell the additional 1,000 treasury shares that I had. So this is on March 30th. Again, I'm going to be receiving cash. I'm going to get rid of the treasury stock, but I'm going to leave myself a little bit of extra room there. Now again, I'm selling back 1,000 shares. So remember, I paid $11,000. In fact, if you think about it, we're being pretty consistent, because up here when I first bought it, I debited treasury stock for $22. I sold half of it. I credited for $11. Another credit for $11. So now it takes it all the way down to $0. And now I'm just going to go up here and delete this because I don't need this little notation anymore. Now this time I sold it for $9,000. So evidently the market price of the stock has fallen. So we lost some money here. In fact, we lost $2,000. But I do have a little bit of a problem. I have paid in capital on the treasury, and I do want to debit that, but I don't have enough in my paid in capital on the treasury to cover the complete loss. I only had made $1,000. So that's why this is going to be a 4-line entry. I've got to find another place to get this other $1,000 from to make up the difference. So in that case, I have no choice but to take it from my retained earnings. So I can't take any more out of my paid in capital on the treasury than what I have in it. So always remember that. Now the next transaction is on April the 1st. We have now declared another 50-cent per share dividend. We know exactly how to handle that. We had a journal entry like that before. We know that the money comes from retained earnings. And we know that because it is a declaration and not a payment, it's a liability, and it's a liability called dividends payable. Now, the last time I did this, I used $25,000, but this time it's going to be a little bit different. At this point, I have actually sold back all my treasury shares. So the question is, how many actual shares of stock are actually out there? Well, I started out with 50,000. I issued 2,000. That took it up to 52. But then I bought it back, which took it down to 50. But between these two entries, I've sold it all back. So right now there's actually 52,000 shares. So 52,000 times 50 cents. Now it's going to cost me $26,000 for this dividend. And then the next transaction, which is on April the 30th, we are simply going to pay the dividend. So this is on April the 30th. It's going to cost us $26,000. Since we're paying for it, we are settling the liability, and we're going to pay for that with cash. So we'll debit dividends payable and credit cash. And then the final transaction is occurring on May the 1st. We're going to issue 1,000 shares of common stock, but this time instead of selling it for money, this is going to be a trade. We're going to exchange it for land, and the land is worth $11,000. So this is on May the 1st. Now, in this case, we're going to receive a new asset, and the asset is this new land that we're trading for. And it says that this land is worth $11,000. Now, what are we going to give up for this land, or what are we going to issue for this land? Common stock. How many shares? 1,000 shares. Well, remember, I have to use the par value. This stock has a $5 par, so that has to be 5,000. So that leaves an additional 6,000. And where is that going to go? That's going to go to my paid-in capital, but it's my paid-in capital on the common stock. So that shows you that sometimes we trade our stock for an asset. And if another company has an asset that we want and they're willing to take our stock for that, we can do that. We'll execute a trade and then record that as an entry. So that completes this example on corporate stock.